Today we'll be talking about Fed's signal on tightening. Again, none of these are investment advice. I'm not a licensed professional. Please do your own research. First off, let's talk about the executive summary. The Fed is signaling tightening. I understand that it's for later on, but it's how the market took it that is important. Um, Next up, let's talk about the inflation narrative, how everyone is talking about inflation. So this is something that's interesting where, when everyone's talking about it, that's the time where you need to be cautious about it. So when no one was talking about it, like last year when, like right after the pandemic blew up and how all central banks around the world all participated in massive monetary expansion, that's when the inflation trade is a lot more safer. You're not as concerned. But nowadays, when everyone's talking about it, that's when we should be cautious. And I'll talk about the potential for it to be over. Um, and finally, we'll talk about the impact on the different assets. So these are the topics we'll be going over today. So first up, let's first talk about the Fed summary. So given the June meeting, what Powell came out and mentioned is that they're uh, expecting 2 rate hikes prior to 2023. So, this could be my bet is probably not going to be this year, but it could be next year, sometime like 2022. They're keeping QE rates steady, but I'll talk about it just a bit how it might not matter in the two kind of pictures we have on the right here. And then finally, they're increasing rates for various program. IOER up by 5 basis points, same with overnight RRP. Now let me talk about how, if we take a look at on the right here, we can see that the balance sheet, which is the bottom picture, we're seeing now its first time hitting $8 trillion. And that is a massive increase in terms of the balance sheet. We can see from COVID all the way up. Now, yes, they're committing to continue QE, but what is actually happening when the funds go out? So what happens is they print money and then they buy assets, and that's why the balance sheet in terms of assets increases. But where is that money going to? Well, we can see on the top picture here, overnight RRP. So this is where institutional or Fed approved institutes can put their money back with the Fed for, the overnight RRP rate, which right now would be 0.05%. But what we can see here, there's a massive ramp up, especially after the Fed announcement of hiking rates or for the overnight RRP. And we can see right here, this is $200 billion, $235 billion in one day after the announcement that is being deposited back into the Fed. And so what's happening is, yes, they're keeping QE expansion on the balance sheet side. However, what's happening once that money went out, it's immediately deposited back into the Fed, especially when right here we can see, for example, this week from June 9th and June 16th, we can see an increase of $100 billion, but we're seeing 233 increase back right into the Fed. So on paper, they're saying, oh yeah, we're still expanding, we're still printing, but on the back end, how the market is reacting is these institutions, like investment banks, that's mainly and large hedge funds, they're moving money back into the Fed. So they're not, they're running ahead of the curve. They don't trust that, Fed is saying hey, yeah, we're still good, no rate hikes for a long time. They they are going ahead and say, nope, we're done. We're gonna put money back with the Fed. We're not gonna lend it out. We're not gonna, do anything with it. We're just gonna put it back with the Fed. We'll earn our 0.05% because they're not willing to risk it on other assets, meaning they're holding a lot of cash. They don't want to put into the equities market. They don't want to buy well, you can buy bonds and put it in here, but the point is they're not willing to take any more risk. They don't think they rather take the 0.05% and not do anything with it. So that is the kind of key point in terms of how on paper, if you just look at the balance sheet, it looks like the Fed is still expanding, but as a net effect, there's actually a lot more money flowing back into the Fed instead of what's coming out. So now let's talk about the inflation narrative. So as mentioned before, I brought up the inflation idea when they first printed a lot of money in expansion of QE, and also when nobody's talking about it. But now everyone is talking about it. So this is where something that we should be cautious about. Like, is it over potentially? So as inflation increases, US, as a country, is a massive importer, has trade deficits with many countries, especially China. But how the Fed can manipulate that is by ensuring, the only one thing they can control is the value of US dollars. That's their whole job. If that can't be controlled, then what's the point of the Fed? Because they can only print money. Yes, they say they can manipulate interest rate, but how they do it is by using QE to either buy or sell treasuries to and also MBS now, and also the junk bond ETF, but that has already been reduced, like we mentioned before, but to influence interest rates. And by raising the value of US dollar, what they're effectively doing is offsetting the import prices to be higher because of Forex. So as long as foreigners are willing to export to US, then there's no issue in terms of, they're just printing money to buy stuff anyways. And as long as the foreign countries are willing to import US dollar in exchange for exporting goods to US, the game can continue. And that's if the foreigners have a need for US dollar, put obviously for oil being one, and for US investments. Now, why so much on US investments? So if US can actually cause other foreign markets to underperform US market, then foreigners have a more incentive to invest in US instead of their local markets, and they will be more willing to export to US. So this will be key. And looking at the US-China relations, seeing how China is the biggest exporter to US, the key will be when and if will China, stop taking so much US dollar. And since they're trying to build up their own currency, build up the strength of their own currency, I don't think that's happening anytime soon, because you can't just replace the US dollar immediately. But I think eventually it'll happen, but in the short to medium term, that's a continuously developing story. And like I said, no one's talking about inflation before. Now everyone's talking about it. So unless the inflation expectation can continue to rise, it's unlikely to cause a chain reaction. So what I mean by that is, if people are expecting inflation, they can see prices continue to rise. They will go ahead and buy more stuff now, which cause more short-term demand, which then causes more shortage, which for more people, they'll see, oh no, prices are going up. Now I must buy more, or I can't buy it in the future. But because the currency is remaining, it's actually rising now, And also the suppliers, they see increase in import prices, but they're not passing along those increased costs onto their consumers. And so what's happening is we're not seeing as much inflation as we otherwise would have, or maybe it's just late to come. So if it's late to come, then maybe we'll see the chains reaction. But if not, then inflation expectation is going to be hard to continue. And finally, we talked about shipping containers before. So before there was a pretty massive shipping container shortage, but now it's seeing an improvement where, potentially maybe there's more people working now. They're not shipping as much. Maybe as US reopening, there's more production. Who knows? But and one thing to note is those supplier equities might have seen their peak. So the idea in summary is that no one was talking about it before. It was a lot easier and a lot safer to trade, to have the inflation trade. But now that everyone's talking about it and that Fed has come out to start the tightening talks, and how institutional investors, some of them, are beginning to buy into the fact that inflation is only transitory, and they're investing not based on what the data is saying right now, meaning like what the CPI is right now, like 5%, but they're looking forward. So because of that, then that has impact on, what we should look into for, investment wise. So now let's talk about US dollar and Treasury's impact. So the US dollar, the DXY bounced off 80, like 89.90 range. And if it can put, like right now it's 92.32. If it can push above 93, we might see 98. So depending, it's a continuous developing story, but I think it's quite possible and probable. Treasuries, so we saw an initial spike in yields, but the long end has actually come back down a little bit. The bigger move is in the 5-year, and we might see the short end to start to catch up to the long end. So meaning the whole yield curve will start shifting from the short end quicker than the long end, or the long end may stay unchanged. So this is potentially from the desire to shorten duration. So meaning the shorter end will be more favorable, potentially from maybe the US, like watching Fed having to tighten, then maybe they'll start selling on the long end. So if they start selling, then the long end won't worth as much. So you're trying to buy the short end to like be more prepared. Like if anything happens, you can just hold to maturity. You're not as exposed. Now let's talk about some equities impact. So we saw that major indices all decline, with NASDAQ declining the least actually. So tech is holding up so far, but as there's more flow from growth to value, because there's and especially with the impact of real rates. So real rates, we're looking at the tips right now. The tips actually, came back like higher. It's still negative, but if real rates are to rally, what happens is valuation will be impacted because it's discounted to present value. But with growth, because it's so much based on growth instead of a consistent cash flow like value would be, like in terms of dividend, then it has more negative impact on valuation if real rates are to increase, if versus the impact it has on value. And I think the speculative stocks will lead the decline. If that's why we saw crypto get wrecked for the time being, and it will come along with the crypto stocks like your MicroStrategies, a bit of Tesla, and meme stocks. So these are very speculative stocks. I expect them to lead the decline or further decline. The question is how much longer can the tech stocks hold up? and support the indices. And so that is something to continue to watch. China equities. So the financial sector, even though the stronger US dollar happened from the Fed announcement, it's actually still holding up all right. And because of normally you would have seen a shift from foreign investors away from China market back into the US if the US dollar is strengthening. But they're actually holding up all right. And so the question is, when will China deleveraging process be done and over? Because once that's done, then I think the next outperformance will be in the China market, because they're the first one to deleverage and they have the most optimistic outlook. So commodities impact as Fed moves to more tightening, signaling, and the market reacting. We're looking at the ending of the reflation trade for commodities. I think the long-term wise, there's still a chance for the commodity super cycle, but like in the short term, like a year or two, I think it's probably over. So the best performers of the whole cycle, or like what we saw in terms of the reflation trade from 2020 March, when the pandemic first began in US, is leading the decline, like lumber, copper, agri-goods, corn, soybean, wheat, with soybean I think performing the most, and then corn, and then wheat. So copper, we're seeing, like lumber, I have no idea. I think maybe because of the high prices, maybe the mills are willing to restart, maybe with lockdown removing in North America, maybe more people are like going out to cut wood and they're selling a lot more like future contracts. I talked about this before, where when the commodities prices are really high, the suppliers are coming in to sell long end futures to secure those prices because they're very profitable. So copper, we saw like Chile exports is near all-time high, and when that happened last time, the prices started coming down. Agri, so there's massive increase of U.S. farming for corn and soybean, and we can see that potential, like the farmers are probably coming in to sell long end futures to secure those contracts, to secure these high prices, and then massively increasing their farming area to in the future to meet those obligations on the FX market, or sorry, not FX, the futures market. And another thing is the decrease potentially in China demand, as pork prices are falling for 4 straight months. So we got to look at the pork ratio or hog ratio to corn, where because it takes X amount. So I think maybe 6. I'm not too sure. 6 pound, like 6 in terms of weight in corn, in order to grow, the same amount of weight in pork. So if that ratio decreases below whatever the threshold is, then they're losing money by feeding hogs and selling them. So if that's the case, then you see the reduction in number of pigs. So if that happens, then it further reduces the demand while supply is increasing. This is very bearish for the agri-goods. Precious metals, so it looks bearish, especially after, like, if the tightening cycle is really beginning. And we have already seen a initial impact. I expect to see some, some bounce, dead cat bounce probably. But the key point is if gold can hold 1680. If it can't hold that, then it's over. We gotta wait till the next one. The silver short, I don't know how that's going. until it breaks $30, like breaks above 30, then I wouldn't put too much attention to that. Oil. So oil was it was the last commodity to rally to have like a new all-time high before crashing down, while other commodities already fell. So oil would be something to watch in terms of can it keep going? If oil can't continue to rally as well, then it's over in terms of like the whole reflation commodities trade. So we've been jumping from each commodity to another. It kind of like goes in a row, right? And so the first ones to rally the most, they start declining, and then the next move on. And since oil is the last one to move, then once oil start declining, then it's all done. So a few factors. So reopening in U.S. is pushing up demand. We saw a report come out of Oklahoma, oil storage being quite empty. But another thing we need to watch on the demand side is the India variant. I think is it Delta? COVID-19 variant Delta. So for example, UK, it's actually impacting Europe quite heavily. UK was supposed to be done with lockdown, but they're pushed back a month now because of that. So that's again something to watch, because again it would decrease demand. So continues to observe. Finally, I just made a bonus slide. These are things that I don't know where to fit them, and don't really have too much knowledge about it, so I'm just talking about it on a high level. So US unemployment, from the unemployment reports, we're seeing that a lot of baby boomers retiring, like they're starting to retiring early, and this could be like maybe they have a few years left before retirement, but they're just saying like, you know what, like if I'm not working already, or like I made enough, I'm done, I'm taking off. And they're taking advantage of their inflating investment portfolios and real estate prices. And this has a long-term impact on US labor market and US company production, because they have the most experience and most expertise. And as they are taking off early than planned, otherwise, there potentially could be a lack of transition of their expertise, like passing down their expertise and experience to the next generations. And another point I didn't really put in here is, people aren't willing to work. There's a lot of people still unemployed in US, and because of all the COVID benefits and payments, they're unwilling to go back to work. So this again will have a long-term impact, as like potentially these companies are realizing, hey, these workers aren't willing to come back anytime soon, but I need to continue business now. So if they move for more automation, what happens is when these employees are willing to come back to work, those jobs probably won't be there, because you weren't there when I needed you. So I had to pick, machineries or automate it or export it to, a third world country. And now that you come back when you're willing to work, the job might not be there. Real estate. So this initial supplier shortage of, high lumber prices has, put a reluctance on builders to build houses. And that's one of the factors that we saw that pushed real estate prices higher, because because of the higher cost, it cut into the margins of the builders, and the builders are just like, screw it, I'm done. I'm not doing it. Another point being on the lending side. So banks are not pushing for more mortgages. So we're not seeing further decrease on the mortgage rates. So, and I expect the MBS purchase, so mortgage-backed securities, to continue to decrease. And what happens is then there's not as much demand on the investment side for mortgages. So meaning if no one wants as much MBS, so potentially like central banks like the Fed will start selling them. They don't want these mortgage-backed securities anymore, then there's not so much demand for mortgages, and therefore there's not so much demand for or motivation for the banks to lower mortgage rates. And if there's not such appreciation or motivation to push down mortgage rates, then for new buyers, then there's not as much they can afford to borrow, and they can't pay for these crazy high real estate prices. So maybe we'll see a real estate prices reflect on that. And finally, so this is the picture to the left, finally referencing it for natural gas. So we can see as the price rallies here, we're seeing there's a net short position that's continued to build. And this is potentially from institutional investors. So this is something to watch. This might be, if the natural gas price start to decline and the short position continue to build, then we can see, this could be a good opportunity to get with the flow. So, this is just an idea.